when you look at some of the risk factors out there, how do you look at the U.S. election, and how does it actually change some of your investment advice depending on what administration we get in November?
Good morning, and thank you for having me on this program. We have a long-standing view of U.S. preeminence, and we keep recommending our clients to have an overexposure to U.S. risky assets. We don't see the election as being a pretty dramatic shift from a structural perspective. There are obviously two main economic themes that we think the markets and our clients will be focused on. First will be the tax policy in case of the Biden administration were to be in office. And second, clearly, what would happen to the dynamics between the US and China and the trade tension relationship in cases. On the first, what our research shows is that there is, not much of a difference between a Democratic or a Republican presidency. So on the, longer-term, medium-term impact of the on the U.S. Equity market, what matters is clearly also whether we have a divided or a unified Congress. But despite the fact that our clients are quite focused on the possibility of tax hike in the EU, particularly on corporate taxes, our view is that once in office, Biden is unlikely to pursue, the full the tax agenda that he has in the pipeline. And this because initially the economy will still be weak and recovering from the pandemic, and there seems to be a widespread view that fiscal policy needs to remain pretty easy. In fact, if you also look at the current debate in Congress, Republicans and Democrats differ on the size of the fiscal stimulus package, where Democrats would like to have a larger package than the Republicans are suggesting. So even if there were to be some tax increase much milder than what's on the agenda in our view, that could be compensated by spending increases, which should continue to support the economic recovery. On the trade tension,
I was going to ask you a bit more about the trade tension. So how does it play out under a Biden administration? Are we going to see more antagonizing of China or less than what we've seen from the Trump administration?
Look, when we think at the structural issues that are going on between the US and China, not just in trade, but also in technology and geopolitics, we don't think that Democrats and Republicans are that apart in the sense that there is a widespread willingness to change the relationship that there have been so far. However, what can change is the way in which the relationship, a new relationship is put in place. Now, the current administration has obviously privileged tariffs and on goods to try to reduce the trade imbalances between the US and China. If there is, a more multilateral approach, less unilateral, less focused on tariffs, but more focused maybe on trying to get China respecting what are the international, playbooks in technology and trade. That could be a positive for the market. Our own research department has basically estimated, very interestingly, that about 10 billion increase in unexpected increase in tariffs on Chinese goods basically had detracted in 2019 something around 1.2% to the S&P. So if there were to be, less, antagonizing relationship that are focused on increases in tariffs, that could be welcomed by U.S. risky assets. That's the conclusion of this report. Similarly, FX could benefit because when tariffs were imposed, the US dollar increased, Japanese yen appreciated, and EMFX basically depreciated as a consequence. So these kind of trades could be unwinded if tariffs are not the primary tool.